Hi, this is Alessio. I hope you're well, and welcome to another lockdown edition of our videos. I hope you're keeping healthy and well, and I hope your family is safe and well also. Now, we just started the Easter holiday, so I'm hoping you're going to have a relaxing and pleasant holiday as well. So the subject matter of this video is, well, first of all, what we're looking at here in the major markets. We had a massive crash in the month of March in both the stock markets and Bitcoin. Both Bitcoin and stock markets suffered pretty disastrous drops, as we can see here. The S&P fell about 34%, the Dow about the same, and Bitcoin had a massive crash of its own. So the big question I want to discuss in this video is, how do we decide, how do we know, or how can we analyze what will potentially happen next? You know, what kind of clues, what kind of things could we do to find out or ascertain better as to what may happen next? And by the way, before we start, let me just also mention this. This bounce you see here, this nice 20% rally in the stock markets we've seen so far, this is a bounce that we predicted was going to happen. In fact, I mentioned in my previous videos that, you know, ignore everybody else, ignore what the majority opinion is out there, that we're going to pretty soon see a massive reversal in the price, which is exactly what happened so far. Now, we'll talk more about this in this video. So there's a number of theories right now floating as to what may potentially happen next. So one possible theory is that this bear market crash is nothing. It's just a beginning. That this is just a bounce. Some people call it a dead cat bounce, or just a bear market rally. That pretty soon this rally will fizzle out and off we go. Major crash again down below. Maybe to retest the lows down here or slightly lower. So that's one theory. Then there is the ultra bearish theory. I've seen this being mentioned quite a few times by some people, that this is going to be the same as 1929. In other words, they're speculating that the second theory is that we're going to experience a much bigger crash, the ultra bearish scenario. That this rally we're seeing here is just a bearish rally, bear market rally, or a bull trap, you want to call it that. And then pretty soon we're going to see a major crash going down like similar to 1929, depression style, a 90%, I don't know, whatever you want to call it, 80%, 90% crash, continuation crash in the market. So that's the second theory. The third theory being put forward, and this is something very few people are talking about, is that we experienced a V-shaped bottom. In other words, the bottom has already taken place. In other words, we're seeing a V bottom and off we go. In other words, it's the start of a bull market rally, and we're going to continue going higher in the next few months, and we're going to see all-time highs. So that's the bullish scenario. So we have at the moment here, if you want to call it, three scenarios, right? So once again, the first scenario, just to recap, the first scenario being, this is a bear rally. We're going to come back, experience, and retest the lows, maybe a W-shaped bottom or something like that, maybe just slightly lower, and then rally higher. Then the ultra bear scenario, the 1929 depression style, massive crash of 90% lower, and then the bullish scenario, V-shaped bottom, right? So these are the three scenarios. By the way, I forgot to mention the fourth scenario, which is we're going to have a kind of a pattern, like a mustache, coming back down here, smiley face, a mustache, something like that. No, okay, I made that up. All right, that's not a pattern. Anyway, the bottom line is that we have these three different theories, right? The three main scenarios. The question becomes, and how do we choose among them, right? I mean, you got these different, views or different opinions, and you have these different interpretations, you want to call it that. But how do we decide which is the correct one? So the first thing we want to do, the first thing we should remember is this, and I want to go through this procedure of how we analyze the charts step by step. All right, guys. So the first thing I would do, and the first thing I would encourage you to do, is go with this assumption. What I'm going to say now may actually shock you, because very few people are actually going to say this to you, but this is absolutely true. So the first assumption you want to begin with is that nobody knows. All right, guys. This is, by the way, this is something most financial gurus will never tell you, is that they always pretend to you, oh, they know exactly what's going to happen next. They pretend just because they call themselves experts, right, that they know what's going to happen next. No, guys, always start with this assumption. First of all, nobody knows. So what I mean by that is nobody knows for sure. Nobody knows for certain. Guys, listen, you could be the most amazing financial analyst on the planet. You could be someone who's made accurate market calls 90% of the time. Doesn't matter. That person, doesn't matter how many times he got it right. He could still be wrong on his market call or prediction now. All right, guys. So remember, guys, always start with that assumption, which is nobody knows. All right, guys. There's absolutely no certainty as to the future of the market. Okay, there are no certainties. There are only probabilities. But guys, the bottom line, the point I'm trying to make here is that nobody knows for certain what's going to happen next in the financial markets or Bitcoin. Okay, this could be a chart of Bitcoin. It doesn't really matter. So whether you're looking at a chart of Bitcoin, stock markets, currencies, gold, whatever, The fact is, always start with this first assumption that nobody knows for sure. It doesn't matter who is saying it. Some guy on CNBC, some guy could go on CNBC or Bloomberg, make an amazing case for a bearish scenario. Oh, I think the market's going to go crashing, go down 80%, 90% like 1929. Okay, fine, that sounds great. But the fact is, guys, he could be wrong. So guys, always start with this first assumption, which is nobody knows for certain. The reason why this assumption is important is because it can actually clear up your mind to think more objectively. All right, guys, never assume that just because some hotshot goes on TV or podcasts and he says, well, I think 100% or I think 99% probability the market's going to go up or market's going to go down. He doesn't know any more than anybody else. All right, guys, nobody knows. So start with that first assumption because it really can clear your mind and think more objectively. Now, let me just make this very clear. Just because I'm saying nobody knows, and this is the mistake a lot of people make. I want to make sure I'm clear on this. Just because I'm saying that nobody knows for certain does not mean that everybody's opinion is the same. Okay, so I'm not saying the opinion of somebody who's never studied the chart in his life. So someone in the street who's never looked at a chart, who's never studied the markets, doesn't know a single thing about financial markets, that his opinion is as good as yours or mine. No, that's not what I'm saying here. I'm not saying all opinions are equal. All right, guys. No, I do think it's important to specialize in a certain field. I do think we do need to listen to people who have a specialty or have studied the markets really well, studied the charts really well. So I'm not saying all opinions are equal. That is not what I'm saying. So I do respect the opinion of certain people in the financial markets, like traders like Linda Raschke or Peter Brandt. I do respect their opinion. Do I agree with them all the time? No, I don't. And sometimes I disagree with those financial traders. So all I'm saying is that we do need to listen to, people who do know what they're talking about. We do need to listen to people who are specialized in a certain field, like charts or technical analysis. But all I'm saying is that whoever they are, they don't know for certain what will happen next. All we have are probabilities, not certainties. So that's the main thing I want to get through. Let's go to point number 2. The second big mistake that you might make, and I've made this mistake myself, by the way, guys, which is that what might happen is you might choose the interpretation of the chart, or in other words, the scenario that you feel more comfortable with. So for example, if you already believe, if you already think the market is toast, the market is going to go down severely lower, if you're already bearish about the markets, maybe because you're hearing some bad news about the economy, what might happen, and the big mistake is you might listen to only experts or, shall we say, people out there who have the same opinion as you. And that's called confirmation bias. Confirmation bias is a very dangerous indeed attitude towards analysis, because what you're doing is you're only listening to people who have the same opinion as you. In other words, you're reading into the market what you want to believe is true. All right, guys. By the way, we all do this. We're human beings, and it's okay if you do this. I've done this too. It's a big mistake. This is why it's important to follow these steps to make sure you don't make these mistakes. So what's important, what I'm trying to say, is never just listen to people who've got the same opinion as you do. Actually listen to those people or those experts or people in their field, those analysts who have a different opinion than yours, because they may be right. So it's really important that we do listen to contrary opinion. Even if those opinions you may disagree with, I think it's important that we do listen to them, because they actually may be correct. Doing that actually avoids confirmation bias or cognitive dissonance. All right, guys, let's go to step number 3, the third thing you need to do as professional traders or professional analysts of the market. Now, the third thing is quite controversial, but it's really important, which is that, the 3 scenarios I mentioned at the beginning of the video, the 3 scenarios, the bullish, so we had the bearish one, the retest, then the ultra bearish one like 1929, and the very bullish one. So the third thing I would say is this: believe that each one of those scenarios is possible. All right, guys, I know it sounds quite weird, but it's really important. You need to believe, again, as professional traders, professional analysts, or professional investors, you need to believe that each one of those scenarios could happen. If you read the book, a fantastic book, by the way, I recommend, which is called Trading in the Zone by Mark Douglas. He says something, I think it's chapter 8, chapter 9. He says that you need to believe that anything can happen. Anything can happen, and that every moment in the market is unique. And something he mentioned in the book is you have to have an unshakable belief in uncertainty. All right, guys, and so this is really important. You need to actually believe in possibilities, not just probabilities, but actual possibilities. I spoke with Peter Brandt about a year ago, and he said the exact same thing. He said that he doesn't just believe in probabilities, but possibilities. This is really important, because if you make the mistake, which I've made as well, by the way, and I'm sure you made it too, everybody's done this. If you fall into the trap of only believing in one particular scenario. So for example, if you fall into the trap of thinking, oh, this market is definitely going to have more downside. definitely, absolutely, or very, very likely, we're going to see more selling. I've seen already many people on CNBC and Bloomberg already say this. Yeah, we're going to see much more selling. We're going to go to 1,700 on the S&P. This market is going to be in a bear market for years, and we're going to be in depression. So listen, those guys can make an amazing case on television or podcasts. Doesn't mean they're right. You may choose to believe them, and they may be right, but the fact is they also may be wrong as well. So you do also need to, so what I'm trying to say is believe anything is possible. Right? Anything can happen. So yes, the ultra bearish scenario could happen, but the bullish scenario may be correct as well. So you need to entertain both scenarios at the same time. I know some of you are probably thinking, so am I saying that each of those scenarios has a 50% probability, like 50-50 toss of a coin? No, I'm not saying that. I'm not saying that each of those scenarios has an equal probability. That is something different. What I'm saying though is that each one of those scenarios could happen. In terms of possibilities, they could happen, right? Now, then we go to the next stage. Even though each one of those scenarios, the bullish, bearish, or ultra bearish, either one of them is possible, yes, but then we assign them probabilities. So now what we do is we say, okay, the bearish scenario, well, according to my analysis, has this much probability, okay? Maybe the probability is, I don't know, 60%. Or it could be lower, maybe 30%. And then you give a probability to the second scenario and the third scenario, like the bullish scenario. So you say, okay, well, the bullish scenario, based on what I'm seeing on the chart, has about a 55 or 65% probability. Okay, so you want to give each one of the scenarios, the bullish and the bearish, or the three scenarios, you want to give them different probabilities. And what you want to do is you want to choose the one that you think has the higher probability, but also reminding yourself that the one you've chosen as a lower probability, maybe like the bullish one or the bearish one, you want to also remember that also could happen as well. There's always a risk that you could be wrong. There's always a risk that either one of us could be wrong, and that the scenario which we did not think was going to happen is going to happen. So I guess that goes to my next point. You do need to think about risks. That's number 4. Think about the risks. Because if you've chosen, let's say you've chosen the bearish scenario. Let's say you think, okay, this is a bearish market. In other words, this is just a corrective bear market rally, and we're going to soon see another leg lower. We're going to see another leg significantly lower below this. Okay, so you've chosen the bearish scenario, right? Then what you have to do is think about the risk, because what if you're wrong? What if you're wrong and the market continues to go higher? Have you thought about that? Have you thought about what you're going to do if you're wrong? Do you have a plan B in case you're wrong? Because if you don't, then your plan is definitely flawed. And these are mistakes that I've learned from, everybody needs to learn from. Similarly, if you've chosen the bullish scenario, so let's say you're bullish on the market or Bitcoin right now. So let's say you're bullish on Bitcoin or bullish on the stock market. Okay, great. But have you also thought about the risk that you may be wrong? What if the market then reverses and goes lower again? Have you thought about what you're going to do if the scenario which you thought was not going to happen actually did happen? Let's go to number 5 now. Number 5, I would say in the step-by-step plan of how to look at the charts is I would also switch off any news. Whatever the news is, switch it off. All right. Listen, I know right now the news about the economy is pretty bad. I know. All right, guys. If you switch on any news right now, all they're talking about is either the virus or the, unemployment crisis, all that kind of stuff, massive unemployment. And of course, they're already predicting a long-term recession, a long-term depression. Listen, those are stories in the news, in the mainstream media. And that's fine. They may be right, they may be wrong. It doesn't matter. The bottom line is we cannot. The biggest mistake you can make is fall into the trap of listening to the news, all right, and ignoring the price action, the charts. Because guys, listen, if you're an experienced chartist, if you're an experienced trader, I'm sure you'll agree with me on this, that what really matters is not opinion out there, is not what mainstream media thinks or the news. The news is one thing, but what really matters is this, what the price action does, what the market does. The only opinion that matters is the market's opinion, and that's it. So listen, I know the news is bad right now, but remember, the news is always bad after a crash. After a crash, everybody's bearish. Everybody is talking about the bad news. But I found this in my career, that if you're just listening to the news, you're going to forget the big picture. You're going to forget the price action. And as Bernard Baruch once said, show me the charts and I'll tell you the news. Which goes now to my next point. The next point to remember is this, that the economy and the stock market are not correlated. I would say the same thing with Bitcoin. The economy and Bitcoin are also not correlated. So markets, price action, whether it's stock markets or Bitcoin or whatever, they're driven by investor behavior, by psychology, by irrational behavior of individuals, whether it's fear or greed. That is what's pushing this market. Guys, just think about this. During this period, when the stock market went up 20%, this is the moment when we had the worst news about the economy. The day that it was announced, guys, the day that it was announced that the unemployment rate was over 3 million or 6 million was here on this bar. And on that day, the market went up. Didn't go down, didn't crash. The market went up on the day the worst unemployment report came out. So focus on the chart, not the news out there. Forget the news. And just to give you another example, in 2009, we had the worst news about the economy. In 2009, we had the worst unemployment numbers, bankruptcies, and yet the market in 2009 went up 60%, right? So guys, just remember, the economy and the financial markets are not correlated. Now let's go to the next point. The next point, which I think is useful to remember, is this. One way to be objective about the markets and charts is after a market crashes, always look at the chart and define your key levels. I think it's really important to look at key levels in the charts because they can tell you, if, for example, after a market drops, if the market then rallies and takes out a key level of resistance, that could actually tell you that perhaps your bearish analysis may be wrong. All right, guys, so always when you look at a chart, draw key levels of support, resistance, maybe moving averages, maybe trend lines. They can really tell you much better what the price action is telling you about the trend, about the markets overall. Let's go to the final point. The final point I want to mention here before I finish the video is this. And it brings me to this fantastic book by Friedrich Nietzsche, which is called Thus Spoke Zarathustra. Now let me explain to you why I bring up this book and why it's important in terms of analysis of the markets. When Friedrich Nietzsche wrote this book over 100 years ago, I think in the 19th century now. By the way, let me just say this. This book had a profound influence in the world. This is probably one of the most influential, most important books ever written for two reasons. One of the reasons is that Nietzsche invented a word that did not exist in the English dictionary until he wrote it down, which is the word Superman, which in German is written as Übermensch, but Übermensch simply means overman or Superman. By the way, not Clark Kent comic Superman. No, we're talking about a different kind of Superman, which I'll explain to you in a few minutes. So Nietzsche invented this word, Superman or Übermensch, and this book, Thus Spoke Zarathustra, was then put into music, a very famous piece of music which you would recognize. It was written by Richard Strauss, which has the same name as the book, by the way, which is called Also Sprach Zarathustra. And this music was then put into film, a very famous film called 2001: A Space Odyssey. You might have seen the film, by the way. Now, in this book, again, Thus Spoke Zarathustra, Nietzsche makes a very important point, which is that we human beings tend to follow the herd. You might have heard me mention this, but it's really what Nietzsche tries to drive home is that one of the flaws of us human beings is that we often fall into the trap of trying to be in agreement with everybody else. This is actually very human. It's a very human kind of instinct. We want everybody to agree with us. And, I'm sure you've had this situation when you've had an argument with someone, maybe you've talked to some people and they don't agree with you and you're upset about it. And what Nietzsche tries to tell us is, look, this Superman, again, the Übermensch, doesn't need validation or approval from other people. So what Nietzsche is saying here, by the way, let me just say this. Some people have interpreted Nietzsche's Superman as some kind of authoritarian dictator, kind of evil person. That is not correct. Let me just say I disagree with them completely. No, I don't think when Nietzsche is talking about, when he says Superman, I don't believe he's talking about some authoritarian dictator. That is nonsense, superficial interpretation. I think what Nietzsche is talking about is he's trying to tell you how you can be a better human being, better individual. And in Nietzsche's view, to be a better individual, to be a Superman, means that you really need to think for yourself. You need to think alone. So, for example, when you're looking at the charts, who cares what other people think? Richard Feynman, a fantastic scientist, he wrote a book. I think he calls the book, What Do You Care What Other People Think? So even scientists, guys, if you look at the history of music, science, art, they've all been people who are focused on their own thinking. Now, of course, they do borrow from other people's thinking too. They're influenced by other people. But at the end of the day, what makes you creative, what makes you a fantastic individual or person is somebody who does not need validation or approval from other people. So what Nietzsche is saying in this book, Thus Spoke Zarathustra, and when he calls it the Superman, again, he's talking about the way you can be a better individual, a great individual, is by really thinking for yourself, being independent, By all means, listen to experts, listen to specialized opinion, but at the end of the day, guys, you have to make decisions for yourself. So when it comes to interpretation of the charts, it does not matter what the majority opinion is. It doesn't matter what the herd is thinking. The herd, remember guys, the herd is usually on the wrong side. Let me show you this chart. Just recently, about 2 weeks ago, I showed this chart to our members, and I showed that this is the chart of dumb money. Dumb money got so scared, they pulled out of the market. And guys, get this, the dumb money, they got out. They exited the market exactly right about this point right here, when the market essentially reversed direction and went higher. So again, it's always a good idea to see what other people are thinking, not because you want to follow them, not following the herd, but simply because you want to go against the herd. So if the herd is extremely panicking, if they're afraid, you want to do the opposite. That's why, guys, if you look back at my previous videos, and I kept saying this over and over again, I kept saying, look, I'm expecting this market to reverse direction soon, and I said the herd is on the wrong side of the market. I'm going to leave you with the fantastic music of Richard Strauss. This piece of music, again, I mentioned before, has the same name as this book because it was written for this book. Thus Spoke Zarathustra, or Also Sprach Zarathustra. So guys, I hope you like it. Bye for now.